Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, July 5th, 2022. It's 11:39 Eastern Time as I'm starting this one. This is video number 2 for the day, and what we're going to do in this video is we're going to cover charts. We're going to stick to commodities only. I did the last update on the equity markets, so you know my thoughts there if you've seen that one, or even really no change from last week. Um, and so what we're going to do, although primarily what this site is all about, what I do largely is technical analysis, analyzing charts to try to predict where things are going. A big part of what goes into this too is fundamental analysis. Now, fundamentals you can't really trade off of with an exact timing. You can nail the entries and exits if you do it right with the charts. Fundamentals is more of it takes a little while to play out, but I'm going to talk on that. That is my original background. I used to be a stockbroker, investment advisor, business graduate, and so fundamentals are certainly important, and they certainly play into the bigger picture, intermediate term. So I'm going to talk on. This will you'll see where this dovetails into my analysis. So I've continued to maintain for the last few weeks here that we're probably at a tradable bottom with the potential for as much as a 20 to 30% rally. This is the S&P 500, and so far that's been the case. Now, the recent price action is not really very bullish, but it depends day to day. What happens is traders tend to get frustrated in these choppy trading ranges. In other words, as where we're at today is exactly where we were I'm just going back where we're trading right now. You can look at today's candle. Well, that's where we were Friday at one point. That's where we were last Thursday. All the way go back here, Thursday the 23rd, week before. The previous Wednesday, Tuesday, all the way back here to the 13th, Monday the 13th, this candle right here. And so what happens is, it tends to frustrate traders, and try not to read too much into it. Bigger picture is that's the low. That low is held so far, and at no point did I expect it to be a straight shot up, nor do I still. But so far, we have the potential, if we can hold and keep above that low, that we can zigzag our way higher and hit some of those more, longer upside targets. So I've already covered the charts in depth. And the big, just to kind of recap, if you didn't catch that one, I'm looking at the market leading stocks, the Apples and Amazons of the world, the Facebooks, looking at those stocks at support, in many cases with divergences at or near support. With bullish divergences, sentiment being pretty darn bearish. But finally, what I'm going to do now is focus on commodities, and I'm going to talk about Powell. Powell, you guys know, and I've kind of laid off him recently because it's kind of a crowded trade, quote unquote, for lack of a better term, to jump on Powell and criticize him. I was, a very vocal and adamant critic of him way back when he kept the pedal on the metal way too long. Told you it was at minimum gross negligence, how long the Fed maintained their excessive easy money policies, and now we're paying the price. However, what I like to do is predict what the Fed's going to do next. One thing you can count on them, I've said this for many, many years, going way back to Greenspan and before, you can count on the Fed to be reactive, not proactive. They're always behind the curve. They always overreact, and that's why you have these big swings in the market, big bear and bull and bear markets. So, goes back to 2018, fourth quarter. We had the Fed had pivoted and tried to take the juice away from the markets back then, and they had what was later termed as the taper tantrum. Fed started to raise rates and said they were going to continue to raise rates. Market threw a hissy fit, dropped about roughly, depending on what index you're looking at, about 20%. And as I predicted then, the Fed pulled a complete 180, pivoted, and went back to giving the markets the juice. Now what I'm saying is going to pivot again. That's the theory I'm going off here. I'm going to look at the charts and tell you why. And again, it's something I've talked on long ago in the past, and we're going to talk about commodities here. So as of now, there's the S&P still above the recent lows. So a few months, well, actually for the last couple years, really since COVID, I've been was very, very bullish on commodities early on, pushing that trade hard, unwaveringly bullish, and then recently in getting up here, told you it was more of a, I backed off those all those as swing and trend positions, just hit and run, gave you a few ideas here and there, and mostly trading the energy ETFs or energy, I'm sorry, energy futures and or ETFs lately, crude, natural gas, which I'll cover in this video. I'm going to cover gold, everything else. But what I had said a while back and many times since is that where it's easy for everyone to play Monday morning quarterback, but where I say that Powell was wrong and could easily see, if you just actually all you had to do is step outside of your little bubble. I don't know what kind of bubble he and the elite, Fed chairman live in, but anybody that was doing their own grocery shopping or running around buying things and paying for things and not having accountants pay for it would know that inflation was rampant and the economy was on fire. Again, depends where you live. I know some cities had their own little thing, but for most part, we know the Fed was too easy. And what I said is all Powell had to do is look at, or anybody in the Fed, is not wait for these, monthly and quarterly reports, which are lagged and often subject to revision, but simply look at the prices of commodities. There were a lot of also all the business indicators. They hit their metrics, for employment and everything else, but then kept the pedal on the metal. And so this is the one that I've said. There's a lot out there, but DJP is the Dow Jones UBS Commodity Index Total Return. Very well diversified. Gas, crude oil, natural gas, Brent, West Texas crude, natural gas, Brent crude, corn, soybeans, copper, aluminum, silver, live cattle, just about everything. It's a very well diversified and one of the more balanced commodity ETNs. And again, it didn't take a rocket scientist to see the trend that was in play and that we had inflation. This is where the Fed finally started pivoting in rhetoric here, but in reality here, they didn't start raising rates till this year. So, and they did that because inflation was out of control. So this coupled with the housing indexes, which plenty of data there as well, the housing market, the Fed could have seen this inflation rearing its ugly head and certainly took the foot off the accelerator earlier. Okay, that's hindsight. Let's get over that. So now what's going to happen is, and it's already started to happen, is this commodity bubble, not bubble, let's just say trend, has cracked. You can see how much we've dropped in short order, and I'm starting to see some rumblings about this in the press, but you're going to hear more and more about it. And where I'm going, it's going to allow Powell to pivot now because he's been probably overly hawkish in rhetoric lately, talking about the aggressive hikes to come and all this. And the market is finally doing the work. The stock market, number one, most importantly, because Powell, as much as I think he's incompetent for the position based on his track record, you got to chalk it up to him being at least a fairly intelligent guy and knowing that if the stock market continues to fall, and you read up on this, and I've talked about it a lot, pension funds are going to be the next huge, probably the biggest crisis this country has ever seen. Probably something that really is no parallel to, the only parallels would be 1929, the Great Depression. So you cannot continue to see, especially stocks and bonds, real estate, everything continue to fall at this rate. Otherwise, the magnitude of the bailouts are going to be mind blowing. They're going to make what the Fed did in COVID look like a walk in the park. If you start seeing implosion and a domino effect of not just pension plans, but hedge funds, everything else blowing up. So, anyways, I still think we're in a bear market, more to go, but I think things are gonna probably reverse here soon. And my targets. I'm talking at most, I think 5 to maximum 11, 10 or so percent downside from here, but I put a favorable odds on that we've seen the lows. And so here it is, guys. This is it. This is the DJP. Again, a very well broad based commodity ETF, and it's down now 20% in just a matter of a few weeks. So what this is finally the probably more so the talk of the rising rates. Remember, we're still at an relative easy money policy right now. Yes, they've taken rates off the floor, off zero, but we still have what most consider accommodative, especially if you look at the, the rate of inflation, the real rate of return, all that good stuff. But that's a nice knockdown in commodity prices, and it's broad based. I'm going to go over that, but I'm going to tell you that most of these commodity TNs are based on are heavily weighted towards energy, and most importantly, the CPI, Consumer Price Index, and most measures of inflation, the two largest components are energy and housing. We all, whether you drive an old, well, not old, most people still drive combustion engine cars, gas cars, but even these electric cars, it takes energy and electricity to run those cars. So that is one of the biggest costs. And of course, housing as well. And you can see we've had a nice drop here. Let's just look at this. Here's USO. This is the crude oil ETN. Does a great job of tracking crude prices. And you had a clear divergent high. Remember, we peaked here, had a steep channel, what appeared to be a blow off top. We had a big correction. We caught that one. We caught this last one as well. And then what happened is we eked out just an ever so slight marginal new high in crude. And what was missing at this one to make it a lasting top is we didn't have, you have to have, not that you have to have it, but we didn't have negative divergence at all. Now we had a big divergent high, and here it is. So crude is down in a big day today, down, USO is down 8.14%. So crude's dropped almost 20% now in just the last few weeks. And technically, and this is where, now I'm speaking fundamentals, because that's going to be a boon to the economy, especially if we can get down more. We're now 75 on USO. Big support. This is where I think we're going. Next stop down here about 69.50. And then I maintain, which I've had all for a while now since up here, a swing target of 58.60 and this uptrend line. They come in together. I know this chart's a little busy. Let me highlight it for you. There's the uptrend line. There's 58.60 right there. And this is what I think happens. That will be beneficial for the economy and the stock market. Net, it should be. Again, anything's possible. Anything can happen. We could continue to see people sell. We could see a financial crisis, a bank, hedge fund, mutual funds, something blow up. Pension funds, announcing, grossly underfunded, big losses, things like that. Talks of bailouts, taxes being raised. But all in all, I think there's more downside to come, and that should be a net boon for the equity markets. Okay, we got to the point where we're in yeah, we'll call it nosebleed territory, especially gasoline prices. We've seen oil higher in the past, and there's room to go, and I think we are going to get there over time. But let's look at gasoline, UGA. And these are actionable trade ideas as well, but I'm showing you this for both trading, investment opportunities, as well as fundamental analysis, making the case that we're going to continue to see, most likely, I believe, gas prices, actually not continue, start to see gas prices at the pump fall. This is UGA. It's an ETF that tracks the price of gasoline, unleaded gasoline, I believe. There is a beautiful divergent high, just like oil, negative divergence, and now we broke down right here. We had a breakdown last week on Thursday, but we hit nice support, that previous reaction high, this reaction low, about 63.52. We bounced, backfilled the gap. Look at that. Nice action there. Backfilled the gap, got rejected. Now we're below the trend line, and we're starting to crack that support. We took out last week's low. We're below it now. I think it'll go. Whether it's today on a solid close or soon, whether we come up here and back test, maybe later, but I think it'll go, and we'll head down to that next target, 61.12. And then I'm going to give you an additional target here, because I think we will continue lower, roughly 53.61. So in other words, we've already fallen now, just in the last few weeks. We've dropped about 18% or so, 19%. So, okay, so maybe a continuation of the drop of gas. I work from home, so I'm hardly ever driving. The only gas I use nowadays, I fill up my boat every now and then, and Filled up at 6.50 a gallon at the marina last time I filled up. So hopefully it's going to be below 5 next time I go back. Anywho, there's about a 20% drop, but if we go to where I think we're going at minimum, we come down here to about, and that would be from the top about a 33% drop, so another 13% or so. That again should be net a tailwind for the stock market, meaning should help stocks. And what I'm doing here is supporting the case, my near to intermediate term bullish outlook. So that's it, and we'll run through the rest real quick. I'm just going to fire through my list because I don't want this to be a super long video, and I'm going in no particular order. I have a commodity ETN list, so that'll paint the big picture. We were just on unleaded gasoline, UGA. This is COW, which is a livestock ETN. It has live cattle, lean hogs. Big support right there. It's already fallen. This one's come down quite a bit, so there's been an abatement in beef and pork prices. If it breaks that support, and you can see there was a trend line right here, we broke and back tested and we're below it. If we break that, that's going to be even more bearish. I don't know, honestly. I mean, if anything else, you buy support. But the simple fact that we've already come off well off the highs should bode well, fundamentally for the economy. And of course, if that trend line breaks, I don't know. I can give you another target. That really wasn't the intention on this one. There's probably better fish to fry. Might even get a little bit of a rally. But again, that's just one component. There's USO. Again, the crude oil ETN I already showed you. I think I did. Solid breakdown there. Nice clean uptrend line taken out. Divergent high. Yeah, I already showed. That was our sell signal 1. We traded this down. And let me, while I'm on crude, get to the crude futures here. So remember, this was our trade on CL. We had initial short entry right here on the break of this minor trend line, and nice divergent high on the 60-minute chart. Hit the first target, we bounced, put in a marginal, ever so slight newer high, slightly higher high that extended the negative divergence there. Went on down, hit my second target, hit my third target right here. That was added right there as a potential new target. Hit, bounced, and then hit my final target here, T4, which was the downtrend line right there. Remember, this downtrend line goes back with a lot more reactions to the left of the chart here. And then look what happened today. Well, recently we rallied up here, hit trend line resistance and price resistance, and got rejected in a big down day like this. These down days typically don't come in bull trends, they come in bear trends. And again, I think the case can be made for more downside. Whether we bounce first or not, come back, bounce back, maybe 108. Here's the levels if you want to short crude at this point. A bounce back to 108.90 could do the trick. 100.88, or the trend line. And if we happen to take the trend line, I wouldn't do much above there. But you also have a downtrend line here. There's a lot of levels. But either way, I think crude's begun a new downtrend, and it'll zigzag down to those targets I gave you on USO. So there's the max bounce target would be that trend line. And again, hard to call it now, and that wasn't the point of this video. I'll sharpen my pencil and get some trade ideas out. And this is one I've shorted in the last couple of days, but we're very, very oversold right now. We're down 8% right now, or we were down about, gosh, I think closer to 9 or 10 on the day. So probably a near-term bounce, and don't worry about near-term. Again, as far as what I'm talking about, fundamentals, this is where, if take out this trend line, that's where I start to question: is the move over? Was the correction? Did it end right there? If it turned around now, we actually had the potential for divergence, but we just took out the lows on the RSI, and we're pretty much equal lows on the PPO. So again, I still think we'll bounce soon, and or not. But if we do, you have my targets, and I think the bounce will be capped, and I think there's more downside to those levels I gave you on USO. Alrighty, I'm going to fire through the rest of them. UNG, there's another one. We recently shorted off the highs at divergent high 1, 2, 3. Went down here, hit my trend line, which was a roughly 36% drop. And this one is now, it's corrected. And again, this is the takeaway here: is these drops We caught the bulk of that, not all of it, most of it, and got out, on the final target, the trend line. That's a 44% drop. So natural gas prices, back here, in the media, everyone's harping on, oh, they're just going to stay high, go up. Russia, Ukraine, um, Europe getting off the dependence of Russian natural gas and oil, blah blah blah. Well, there's a almost chop in half, almost a 50% drop, 44, 45% drop in a matter of just a month or so there, a little over a month. And that greatly reduces the, not just the rate of inflation. You have a positive rate if inflation continues to increase. And so you started to see an abatement, and that's what trend indicators are all about. That's what all this whole thing I'm doing here in this technical analysis. That's why I use these divergences. They're momentum indicators, and they show you momentum slowing. So you had runaway inflation, super high rates. It was such a lag time. What you're hearing on CNBC and reading in the paper is dated information. By the time you read those reports and GDP and everything else, this is the real time stuff. This is what I was saying, back then. Powell and the Fed could have used. Look at prices of commodities. It's not that hard to do. If you're clueless because you live up in the clouds, in some gated community, and you have people doing your shopping, and you don't know where anything is, that's all you had to do is look at that, and you could have seen it in the charts. But now we're seeing a huge drop. So this is it. This is an abatement. Now, do I think that's it? Do you think that's all-time high in natural gas and all these commodities? No, no. I think the commodities have entered a new bull market that started around the time COVID was over, or COVID first hit. I'm sorry, back in early 2020. And I think this is a pretty healthy correction that I think soon you're going to see the fundamental case for people, and more importantly institutions, pension funds, mutual funds, hedge funds, to start stepping back in the market and buying stocks, because we've seen a powerful abatement, not just a decrease in the rate of inflation, but a drop in inflationary in prices. So that's it. So again, natural gas and crude oil, those are the big ones. We can go through the rest, palladium, and I'm going to get to gold and all that in a minute. Still liking the precious metals. There's palladium. There was a bullish falling wedge, positive divergence, broke out recently. Euros got smacked down today with some things going on over in the Eurozone, but I think I'm going to get to that one second. I think we still have a nice rally coming up in the precious metals. Remember, they're not going to put as much pressure on inflation as food and energy and housing. So it's possible to see them rally. GSC, there's another commodity index ETF. Now that's hit support. So look, what I'm showing you on the commodities, a lot of those have popped. Some are coming up to support. So I may start in the coming weeks here getting back into selectively selectively trading long and short more and more of the commodities, ag commodities, metals, things like that. There's one I don't really know if I'd want to step in and buy. I would probably hold off for now. This one, I think ultimately it will work its way down here to about 1823 and this uptrend line. This is GSG, and that's the iShares S&P GSCI Commodity Index Trust. It one has, I haven't updated it in a while, but it's heavy in energy, about 50 over. Back then it was over 54%. Agriculture about 20%, industrial metals 12, livestock 7.5, and precious metals 5.5. So very important to know what you're buying. If you're buying a commodity ETF, you need to know if you're top heavy in energy, because you better make a case to be long crude and natural gas if you buy this ETF, because it has such a high weighting. And ultimately, again, I think bounces aside, I think we'll work our way down here at about that 1823 and uptrend line level, which gives us a roughly another 15-18% drop. And if that happens again, that should be net bullish for the stock market and for the economy. Cut. That's a timber lumber ETF. Remember the same thing with lumber prices. We're short those off the highs, and they've been working their way down, coming up on nice support. This does not hold lumber to the best of my knowledge. We don't have an ETF that holds lumber directly. You can trade LB lumber futures, random length lumber, but the only ETFs are cut in wood, which hold companies that are in the timber and forestry industry. You know, paper companies, wood companies, those that timber. JJU is aluminum, and that one actually looks good for a bounce here. I can make a case to step in and buy aluminum. JJU, $49 is a support level I've had on this chart for a while. And you've got you have positive divergence and a little trend line which to trigger a long entry. So you can go long here at support and or long on a breakout of the trend line. You have positive divergence as well. And not to mention, aluminum prices have fallen off their peak, at least via this ETF or ETN, almost 42%. So again, this is the news. This is the whole point in this video. Trade ideas number one if you want them, and I'm supporting my case, my near to intermediate term bullish outlook. And again, I made the case earlier today. You can take a long, go long here if you haven't had anything with stops below. I like a staggered scale out. I also like, I just want to say this too, because I didn't mention it in the other video, for 401k type investors, let's say you were, you heeded the warnings back here and you went to cash in your 401k. Because we're getting close, because I would give it at most, again, I can't promise that, but at most my downside targets are another 5 to about 10% down the market. So I think it's a great time, personally, for me, to scale into, to go into your 401k and start, increasing your equity allocations. And scale in, it means start taking some now. And if you set, let's say, your future allocations to move into equities, you could be buying down to those levels. And if we never go down that other 5 or 10%, then what you're doing is you're buying and prices are going up. So either way, I think it's time to start shifting money. Again, not an all-in, not going 100% cash, 100% equities, nor should you really ever be that, especially in a bear market. But again, time to start increasing. And by 401ks have the auto buys every pay period, so it's a way to kind of scale in there automatically by just changing your future allocations. All right, didn't want it to go too long, so I'm going to move on. I covered that. LD is lead. Lead ETN down 25%. Coal is no longer there, but it's the coal stocks that you trade, and I've covered those are all trade ideas recently. But I think I did energy today. Told you energy's at support. If I didn't cover it in the video earlier today when I covered the sectors, you have a uptrend line here on the weekly chart. XLE is at, and then even better price support there, about 65. You also have on the daily chart here. See, here's my trend line, but what I'm going to do is pull this trend line down. Why did I do that? Here, I'm going to turn off all the lines here and show you why I just did that. I hadn't had this reaction low there. I had cut it off before. So if I come in there, catch that reaction low, we're right about on trend line support. So I think bears see a bear flag here and a drop, and that may be the case because look, I'm bearish on crude oil and I'm bearish on natural gas. More so crude right now. Natural gas has had a pretty darn good drop, so I prefer crude. And again, it may bounce soon. That may play out, and that's going to be bearish, but the XLE isn't going to move the needle on the S&P 500. Why? Well, here's why. Turn my levels back on. I haven't updated this in a little bit, but it was only, last time I did, it was only a 2.77% weighting in the S&P 500. That compares to a 25.4% weighting for technology. So energy can fall, continue to fall. It may not. I just wanted to mention that it doesn't move the needle as much as those big FANG stocks that I covered earlier today, which all have divergences, and I think the charts are constructive. Okay. So, oh yeah, coal. I wanted to show you the coal stocks because that had to do with energy. Well, give me 1 second here. Okay, and commodities related. So these were all shorts. I'm just going to go over the ones I gave you a few weeks back. They were my favorites. ARCH, Arch Resources, down about 27% off the highs. I can't remember exactly where I would have given you a last sell signal on a break of these lines, but it's at uptrend line support. Yeah, it's slightly overshooting it today, but we'll probably get a reaction. I would cover that short today. right here, because I think we'll probably close the day uh, on there. Or, well, you know what? Crude can continue to fall. What I do at this point, another option. I'm not still in it, wish I was today, but that was big support there. You can set a stop there, and if we get a bounce, we shouldn't go above that level, because we could go on through there, but usually on the initial tag of a trend line, you're going to get a bounce. Then if you break that trend line, we're probably going a lot lower. And I did give you longer term targets. I have a target all the way down here, but I'm going to give you one more right now if you're trading Arch. 120, 102.91. We'll call that 103. That's a potential target. I'm just going to rifle through the rest. There's the sector. See, the sector's at support right now. Right there, IX 1050 and TC 2000, coal sector at support. But there was our short entry right there, and from there it fell about 17%. HNRG, I'm going to tweak this trend line right now because there's a reaction low there, so coming up on trend line support, but it did just put in a big divergent high. So more to come, I think, on the downside. It's just a matter of, do we bounce first or not? Probably. AMR just took out its trend line there, so maybe we are going to keep going in the sector. CEIX, breakdown, backtest, and doesn't look like a lot, but these are big moves. That's an 18% drop since the breakdown. BTU, there was that head and shoulders pattern I talked about. We're testing the neckline right now. There's the, oops, that was my next target, 1460-ish, and there's the measured target for the head and shoulders pattern. METC just triggered a breakdown or a sell signal on that break of 1324, and I can't remember. I think I might have highlighted this back test as an objective short entry last. If so, that was about a 36% drop so far. So, all right, there it is. You get the picture. And this is coal. These are the coal companies. Look at that drop. So we called it technically. It was priced into the charts. And again, this is the abatement in inflationary forces. We're seeing a correction. These companies aren't dropping because coal prices are going up. They're dropping because coal prices are going down. So I could go on and on and on. This video will go forever. If I don't do gold, you'll be upset with me, I'm sure. So I'm going to get to that in just a second. There's sugar. Here's gold. All along, I've been harping on gold and talking about this big triangle on the weekly chart. Let me go to the weekly for you. And I said, this is really, if I had a line in the sand, I've been saying for a long time, is this 164.80. It's good support, and we're at it now. And so this has to do with what's going on with the euro. Gold's been weak because the euro's been weak, and the dollar's been strong. It's really about the dollar, but I use the euro as a dollar proxy. Don't know why, just do. Charts are a little more clear to me. It's more of a pure play. The U.S. dollar index, USD, is a compilation of all the currencies it trades against, a basket of those currencies, with the euro being the largest. About, I think it's 57.8 or 57.6%, somewhere around there. And then the yen is second largest at 23 or so. And so by looking at euro, you're seeing the pure play. You're seeing the euro. This is gold right here at support. So I just want to say, holding on, clinging to support right now, or just hitting it today on a big drop down. But here's the thing with the euro. Remember I told you last week we were at the bottom of a major long-term support zone on the weekly chart. Right here, this is our support zone. We cracked it today, but I said I could see a little whipsaw down through there. It's certainly possible. That's the nature of this market. It's tricky. So here's where I'm going. This is all going to tie in now. So I think this will probably be a whipsaw, a false breakdown. It's going to flush out. It's going to be a big bear trap if so. So what you want to see in the coming days or weeks, first of all, the week's not even over. This is a weekly chart. This is day one in the week. Well, day two, because the euro was trading yesterday. They don't shut down for the U.S. 4th of July. So we're down below, but the week is still young. And even if we close down a week or two, we get a reversal, that's going to be a bear trap. So it's only a bear trap if and when you break down support and then solidly recover it. And if so, you could get a rally up to that uptrend line, 108 level, and possibly a trend reversal. What would make that happen? Everything I've just been talking about for the last 30 minutes about Powell starting to pivot, starting to say that he's seeing an abatement in inflationary forces, and then again, it's all about the rhetoric, just what he says, and then the interpretation of what he's going to do. So if it's seen that the dot plot, the projected future path of rate increase is going to change, then that would in itself could be a big boon for the stock markets and give us that market rally I've been looking for. So I think that's it. So you see gold at support. You see the euro not looking great today, but let's see how we close the week, and let's see if you start to again. These are the things I'm looking for. Start to hear the Fed, even if it's not just Powell. Some of the other Fed members, they talk all the time, and you'll start to get a little kind of a pulse on which way they might be leaning, and the Fed overall. There it is. There's gold weekly at that support level I just showed you. I'm just going over this GCC. This is another commodity fund, Wisdom Tree Continuous Commodity Index Fund. Look at that support right there, about 2266. This is a weekly chart. Was resistance back there, resistance there. We broke above it, and we're back testing. We're a hair below it now, and again, nice drop in commodity prices that, if nothing else, should be a somewhat of a boon for the economy, or at least help it out, and also allow Powell to maybe cool his jets a little. DJP, Dow Jones U.S. Commodity Index. Look at that divergent high. I mean, it's not like these drops were random. There was divergence there. This one's got a lot of energy in it as well. Haven't updated these numbers in a while, but you can see it was total in oil was about 17%. So there's that big drop there, coming up on support right here. So there's probably more downside to come in commodities. And again, if you do see more downside, you're going to hear more and more and more about the fact that, hey, these rate hikes are working, and it's putting the brakes on inflation. And I think it'll be short-lived. By the time that seems to be the general consensus and everybody's in agreement and the stock market's rallied, that's probably when we want to step in and buy commodities and get back out of stocks for the next leg up in commodities and the next leg down in the stock market. Got to talk on the grains, and then I'll end it. Corn. This is a weekly chart. Big picture. Corn ETN. The symbol is corn. Easy to remember. CORN. Look at this. This was the big thing, and Russia invaded Ukraine. Well, actually, that's wheat. But corn and wheat go together. Yeah, Ukraine's a big wheat producer. But you can see they move together. Corn, wheat, and soybeans are all in the JJG, the grain ETF, ETN, and it had a big divergent high, negative divergence. Everybody was piling in. We were bullish and long back here off the lows when COVID hit, caught a lot of that, but this is where everybody figured commodities were going to go up forever. But they didn't see, big divergences forming, and then we broke trend. But look, we've now pulled back, and we hit really nice support here. So corn may be good for a bounce soon. That's about a 23% drop. That's a big abatement. Remember, grains are probably one of the, if not the most, I would imagine, important food source as far as commodity inflation goes, and as far as hitting people's pockets. In some parts of the world, many parts of the world, beef is a luxury. It's expensive. It's obviously costs more to feed cows and chickens. And the grains, of course, go to it. They're the input to feed the chickens and the cattle and livestock and everything like that. And most people around the world survive primarily on the grains as a primary sustenance. So we've seen a big drop in corn prices, coming up on support 2270 to, I'm going to give you another line here. I'd probably want to step in early on this one right here, about 2322. We're right about on support. And let's see what the 60-minute chart looks like. If it could turn now, it could maybe pull off this divergence. It's in free fall mode, and it could go lower. Remember, this is a crowded trade, just like oil and natural gas and everything. I warned of that when natural gas was at the high. I said, watch. It's a beautiful thing when a crowded trade reverses and there's a rush for the exits. We saw it in UNG. We traded it, caught most of it. We're seeing it now in crude oil. Starting to see, I think, with more to come. Natural gasoline prices. And that's about it. I can go on and on and on. I covered corn. There's soybeans. They move together. Divergent high, falling, falling, falling. I don't have a hard support level, but you can see the chart. It broke support there. Probably a little more downside at least. That's a big divergent high. We could come down quite a bit hard to say. Again, I'll sharpen my pencil, guys, and give you targets. Look at wheat. Oh yeah, look at that. I haven't even checked this one before the video. Back to that previous reaction high, I had a support level there at 833. It used to be resistance. We broke it there. Back to it. Little more downside to hit this trend line. So here's an example of scaling in. You know, if you don't want to catch a falling knife, that's fine. Wait for a sign of reversal. If you do, you can start scaling in here at price support around 833. We're at 834 as I do the video, and with the downtrend line just below. And if nothing else, for a bounce trade, you're going to get a nice reflexive bounce. This is a crowded rush for the exits. Too many people got caught at the top buying and going long. Those trades are getting unwound right now. The pendulum always swings too far in one direction or the other. This was a blow off top, followed by, we tried to go back up, failed to take out or even match that high, and then boom. But we're going to get a bounce soon. So there it is. Now, I know I'm talking double speed, just a reflexive bounce. This is pretty much looks like a significant top for now. And so we get a bounce, even if as long as we don't go run back up at these highs, if we just even stayed and traded around this range for a while, it will be acknowledged that, hey, grain prices are well off the highs, and we've seen that abatement in inflation, and therefore the Fed can slow their roll, and therefore the stock market should like that. Or not. You know the levels. You know where I'm, already showed you in the stock market key levels. If they're taken out, you break those support levels, you go down to the next one. But as of now, I see a lot of things lining up for potential rally, especially if we can see continued downside in commodities, and particularly in energy. All right, I'm going to wrap it up here. Get the video out to you guys. This has been Randy Finney with Right Side of the Chart. Have a great day.